Welcome back to the Deep Dive. Today, we're cutting through the noise around Delta Airlines' September quarter 2025 results.
Yeah, this was a really pivotal call. Happened intraday and pretty much set the, let's say, high-flying tone for the whole airline sector.
Absolutely. And our mission for you today is clear. We're going past just the headlines.
Right. We'll give you the key numbers, sure, the ones that lifted the stock. But more importantly, we want to dig into the why. You know, that strategic pivot they keep talking about, focusing on the high-yield customer.
The one they argue is really starting to separate them from the pack.
Exactly. So let's start with that results snapshot first. How big was this beat? Because the market reaction was, well, immediate and positive.
It was a clear beat, confident, exceeded expectations pretty much across the board.
Okay, give us the numbers.
All right, bottom line, adjusted earnings per share, EPS, came in at $1.71.
And consensus was what, around $1.52 in a voice and $1.53?
That's right. So nearly 20 cents better.
Yeah.
That's significant in this industry.
Yeah, huge when margins are usually so tight. What about the top line? What drove that earnings beat?
Total revenue hit $16.67 billion, which beat consensus by, about $700 million, represents 6% growth year over year.
Solid growth. And operating margin.
Adjusted operating margin landed at 11.2%, comfortably in double digits.
So when you hit those kinds of numbers, the big EPS beat, the revenue beat, solid margin, it really does endorse the whole strategy, doesn't it?
It does. It feels like a strong validation, which brings us to that strategy. Let's unpack this premium tilt idea.
Yeah, that was definitely the buzzword on the call.
Management seems convinced the future of high margins is all about the higher yield passenger. How's that playing out in reality?
Well, the momentum is frankly accelerating faster than I think anyone really expected.
Yeah.
Premium revenue grew robustly, 9% year over year, hit $5.8 billion.
$5.8 billion just from premium. Wow.
Right. And meanwhile, the legacy main cabin revenue actually dipped slightly.
So this isn't just growth, it's a real mix shift. They're actively managing this.
Oh, absolutely. It's a forceful strategic shift.
And didn't they move the goalposts on when premium actually overtakes main cabin revenue? I thought that was a 2027 thing.
It was. That was the milestone everyone had penciled in. But management explicitly pulled that timeline forward.
To when?
They're now saying premium will likely overtake main cabin in Q1 or maybe Q2 of 2026.
2026. That's a fundamental acceleration.
It really is. It suggests, potentially a much steeper ramp in high margin cash flow than the market was pricing in before.
Okay, let me push back on that a little. Moving that target up by a whole year seems aggressive. What could derail that? What if the economy softens unexpectedly?
That's a fair question. I think management's confidence comes down to two main things.
Which are?
One, disciplined capacity control, and two, the physical changes they're making to the planes.
Right, the seats themselves.
Exactly. They're boosting the premium seat count, obviously with new planes, but also through a pretty intensive retrofit program.
How much comes from retrofits?
They said about 25% to 30% of the incremental premium seats are from retrofits.
Okay.
And crucially, at the same time, they're trimming main cabin capacity, especially domestically, where main cabin seats are actually down slightly year over year.
So firming up prices in the back while pushing people towards the front.
That seems to be the play. It helps support main cabin unit revenue while driving that lucrative upsell.
It's fascinating because historically those big seats up front were seen as, costly, high risk.
They were. But the narrative now is completely flipped. Premium products are structurally their highest margin offerings.
And it scales.
Apparently so. Profitability scales with premiumness. The most exclusive seats yield the best margins. This isn't just about image, it's about real margin expansion from mix shift. That's the critical so what here.
Yeah, it confirms the economics are working.
Right. Not just good PR.
Now, obviously, filling those premium seats needs high-yield customers, which brings us to corporate demand. That segment lagged for so long post-pandemic. Is it finally normalizing?
The signs are definitely pointing that way. Corporate sales overall were up 8% year over year.
Okay.
And domestic corporate sales saw double-digit growth. These specifically call out mid-teens growth in key coastal hubs. Think LA, Boston.
That's interesting. Suggests maybe Zoom fatigue is real, and those core business travel routes are bouncing back.
It certainly looks like it. High-yield travelers getting back on the road to major business centers.
What's the most telling number in that corporate recovery story for you?
For me, it's the fact that corporate revenue is now slightly above 2019 levels.
Above, even though volumes aren't fully back.
Exactly. Passenger volume in corporate is still only in the, say, high 70% range compared to 2019.
Right.
But the revenue exceeding 2019 levels, that screams pricing power. And it suggests there's still significant runway for volume growth as things normalize further, likely with fares staying firm.
Okay, let's switch gears to the other big margin engine, loyalty. The Sky Miles program and that Amex partnership. It's almost like a separate business.
It really is, and a very profitable one.
Yeah.
The numbers are just huge.
How huge?
Remuneration from the American Express co-brand deal was up 12% in the quarter. Hit $2 billion.
$2 billion in one quarter from credit cards.
Yep. Keeps them comfortably on track for over $8 billion for the full year.
Yeah.
And marching towards that long-term target of $10 billion annually.
It provides incredible stability, right? A massive, high-margin financial services stream alongside the core airline.
It does. And the quality of that stream is improving, too. They mentioned co-brand cardholder spending has outpaced other consumer cards by like 2x over the last few years.
Oh.
And the new card acquisitions, they're skewing more towards the premium cards.
Which means
Cardholders with better credit scores who spend multiples more than the base members. It just reinforces the health and durability of that whole loyalty ecosystem.
So this focus on premium, on loyalty, on capacity discipline, it's all showing up on the balance sheet too. Management talked a lot about cash flow and efficiency.
They did. And the numbers validate it. Operating cash flow was strong at $1.8 billion.
Generating decent free cash flow.
Yeah, $830 million in free cash flow, FCF, for the quarter. The underlying cash generation is really important.
Why is that?
Well, it helps offset some headwinds they mentioned, like the booking curve normalizing, which can sometimes pressure cash up front.
And costs, especially with inflation still a factor.
That was another key point. Non-fuel unit costs were basically flat year over year.
Flat, even with wage pressures and investments.
Flat, which shows some pretty impressive efficiency gains, even while they're pouring money into those retrofits and fleet upgrades.
And they're continuing to clean up the balance sheet, the deleveraging story.
Absolutely. They paid down nearly $2 billion in debt year to date.
Okay.
And significantly, they repriced their Sky Miles term loan, managed to cut the interest rate by 225 basis points, over 2%.
That saves real money.
It does. And it reinforces that fortress balance sheet narrative. They ended the quarter with gross leverage down to 2.4 times.
So is this just good financial housekeeping, or does this set them up for something bigger? Maybe more aggressive capital returns to shareholders soon, like buybacks or bigger dividends in 2026?
That's definitely the implication, I think. When you strengthen the balance sheet like this, cut your borrowing costs, it just gives management so much flexibility.
Right.
They haven't announced specific new return plans, but having that flexibility means they can be opportunistic, whether that's pulling forward some fleet plans or, yes, boosting shareholder returns. That optionality is a key differentiator.
Okay, so connecting all these dots, strong results, accelerating premium shift, loyalty strength, balance sheet health, the guidance must reflect this confidence, right? What signals did they send for Q4 and the full year?
Yeah, the guidance was probably the biggest confidence signal of all.
How so?
For Q4, the December quarter, they're guiding adjusted EPS to $1.60, $1.90.
Okay.
And importantly, targeting another double-digit operating margin. If they hit that, it would be a record for a fourth quarter.
A record Q4 margin. That's strong. Full year.
They raised the full-year adjusted EPS guidance to approximately $6.
Which puts it where in their previous range?
Right at the upper end of the prior range. And they also updated the crucial FCF guidance free cash flow, now expecting $3.5 billion to $4.0 billion for the full year.
That strong FCF number really stands out in the sector. What about the competitive environment? They made some pointed comments about industry divergence.
They were very clear on that. Management basically said the financial divergence across the industry has never been greater. Meaning they expect Delta and United to really drive the vast majority of industry profits going forward, thanks to their differentiated strategies, the premium focus, the network strength, loyalty.
And they see capacity helping them.
Yes, especially domestically. They noted that competitor capacity in Delta's key hubs is actually down year over year.
Interesting. So less competition in their core markets.
Seems like it. That provides a nice sort of external tailwind for the unit revenues. Less supply helps pricing.
And long term, they still have those ambitious mid-teen margin targets. Are those realistic or just aspirational?
Management argues they are realistic, They point to efficiency gains still being, quote, in the early innings.
Early innings, what does that mean specifically?
Things like fully leveraging their new airport infrastructure, getting more scale benefits from the fleet, better workforce optimization,
Okay.
and crucially, technology. They said tech deployment for efficiency is only in the very, very early innings and should provide margin tailwinds for years.
So if they can execute on that tech piece.
Then those mid-teen margins become much more plausible, yes.
Okay, before we get to our final segment, we have to touch on the one clear weak spot they mentioned, the Atlantic market.
Right, that was the exception in an otherwise strong quarter. The Atlantic was, frankly, disappointing. Unit revenue RAMs was down 7%.
7% down. Why? The Atlantic is usually a cash cow, especially post-pandemic.
Yeah, they attributed it partly to some booking curve normalization issues, that spring swoon thing they mentioned. But the bigger issue seemed to be capacity management. They kind of admitted they structured their summer capacity too peaky, too concentrated in the absolute peak months.
Creating an imbalance.
Exactly. So the plan for 2026 is different. They want to fill the main cabin earlier in the season, more aggressively,
Right.
and manage the capacity distribution across the summer to be flatter, smoother. Avoid those really sharp, expensive peaks in capacity deployment.
Makes sense. All right, time now for our This Is Not Financial Advice segment, our chance to pitch an outrageous but plausible trade idea based on everything we've just discussed.
Okay, let's hear it. But we have to acknowledge, right, that Delta stock often has this history of popping on earnings and then stalling out a bit.
True. That beat and stall pattern is real, which is why, for sustained momentum, the market needs to fully buy into that accelerated premium shift we talked about.
The timeline, moving from 2027 to early 2026 for premium revenue overtaking main cabin.
Precisely. That accelerated margin improvement is the key catalyst. And I'm not sure it's fully baked into consensus estimates yet, even after the post-earnings pop.
So you think there's still more juice left in this trade?
I think there could be. So here's the pitch.
Okay.
Initiate a long-dated call spread. Target the upper end of where some brokers have their price targets, say, aiming for $75 or maybe even higher.
A call spread, okay.
Yeah.
Leveraging the earnings volatility.
Exactly. You leverage the high volume and implied volume from the earnings day. The bet is straightforward. The market hasn't fully priced in the margin benefit of that premium main cabin crossover happening almost a year early. Plus, the raised free cash flow guidance adds fuel.
So it's basically a play on the mix shift happening faster and driving profitability higher, sooner than expected. An arbitrage on the timeline acceleration.
You got it. A mixed shift arbitrage play. Outrageous, maybe, but plausible given the data.
All right, so wrapping this all up, the key takeaway from Delta's Q3 call is really about focus, isn't it?
I think so. Focus on those high-yield customers, focus on the loyalty economics, and disciplined capacity management. It's working.
Yeah, the beats on EPS and revenue, the raised guidance, it all points to that strategy delivering tangible results.
So maybe the most interesting question for you, the listener, to think about long-term isn't just if the premium strategy works for Delta, it clearly seems to be,
Right.
but whether this growing financial gap, this divergence they talked about between them and the rest of the industry, does that eventually force wider capacity cuts among the lower-end carriers?
So could Delta's success indirectly lead to industry rationalization?
Exactly.
Yeah.
If weaker players are forced to pull back capacity more broadly.
That could create an external tailwind for pricing power across Delta's entire network in 2026 and beyond. A rising tide lifts the strongest boats the most, maybe?
Something to definitely keep an eye on. That competitive dynamic is key.
Indeed.
Okay, thank you for joining us for this deep dive into Delta's quarter.
And just a reminder, the opinions you heard today are solely those of the speakers. They're for informational purposes only. This is not financial advice. Please consult with a certified financial professional before making any investment decisions.